Appreciate you checking out another video here from NetPicks. And today I want to talk about one sector of the market that continues to be pretty popular with active traders, and that's the energy sector. And right now, energy prices, they're so volatile that there are a lot of products that traders can use to benefit from this back and forth price movement that we're seeing. Now, the energy products, they're really sensitive to any type of fundamental or economic headline, any geopolitical headlines, as well as the growth in the electrical vehicle space. So as a result, at NetPicks, we recommend every trader have access to the energy sector as part of their toolbox in trading. Now, I want to look at the different oil-related products that we like to use on our side to stay active in the energy sector. And we actually use a variety of products, and that includes futures, stocks, and options. Now, each of these are going to have their pros and their cons, but we're going to spend most of our time talking about two of our favorite oil ETFs that we like to trade when we trade options. So the first one is XLE. Now, that's an ETF, and it tracks a market cap weighted index of U.S. energy companies that trade in the S&P 500. Now, we like to trade this ETF because it gives us exposure to the energy sector using a lot less capital when we compare it to trading the shares of stock or the oil futures market. Now, oil futures, very, very popular with active traders. And the fact is, the futures market, that can move pretty quickly and in many cases produce large gains in just a matter of minutes. But the problem when you're trading futures is the costs that are associated when you're using the contracts. Now, depending on your broker, trading one oil futures contract will require about $6,000 in your trading account. And for every 1 penny that the contract moves, you will make or lose $10. Now, the futures contract, they're designed more for short-term day trading. And yeah, you can hold the positions longer, but as we just talked about, it's going to require a large amount of capital. That can lead to large profits and large losses if you're not careful. So in our opinion, XLE is a much better product to use to get exposure to the energy sector. It's very liquid. It's got big volumes in the shares of stocks as well as in the options market. Now, the price of XLE is going to be impacted the most by what ExxonMobil, that's the symbol XOM, and Chevron, symbol CVX. What they do, as these two stocks make up 45% of that ETF. Over 57% of the stocks that make up the ETF come from the oil and gas refineries. So while the ETF won't be a direct correlation to the price of oil futures, they will provide a great way to get exposure to the energy sector for a lot less cost. XLE, very liquid options in both the weekly and the monthly options. So this makes it a lot easier to get in and get out of trades quickly and at pretty good prices. And while the weekly options are really attractive in active markets, we actually prefer to use monthly options in a lot of cases. And our sweet spot is we want to look for between 20 to 60 days left to expiration with the options that we're trading. We also use a mix of long calls and puts as well as vertical spreads, depending on the market conditions, of course. And using a mix of strategies, that gives us more flexibility in different market conditions that are out there. Now, thinking about XLE for a second here, it has a daily ATR, right, average true range reading, of $1.38, which means it's an active product with a track record of good movement. The average daily volume on XLE comes into just under 32 million shares, which means that's a pretty good liquid product for active traders. The other one, it's United States Oil Fund. Okay, it's symbol USO. So if you're looking for an ETF with more of a direct correlation to the price of oil futures markets, then this is a great product. Okay, because it tracks the price of the WTI crude oil futures contracts. Now, while this could be ideal for oil traders looking for a cheaper product versus trading the actual futures market, it doesn't really offer the flexibility that XLE uses. So when we trade USO, we primarily stick to long calls and long puts. Now, in most cases, the options prices, they're just too cheap, and the liquidity, it's not good enough to trade vertical spreads. but we will use a mix of weekly and monthly options on USO over time, as long as the options have between 20 to 60 days left to expiration. Okay, the monthly options, they're going to have better liquidity, which makes them easier to trade in most cases, of course. Now, the ATR, the daily range of USO, 74 cents, which is pretty decent for a $36 ETF. And the average volume on the USO stock comes in just over 6 million shares. So the liquidity in USO makes it a good product for traders looking to take simple directional trades. All right, so let's start out with taking a look at a trade on USO using a long put option. That gives us a bearish position. Now, I mentioned earlier that we want to see between 20 to 60 days left to expiration on the option that we're trading. So this is going to have us looking at this point in time at the March monthly options with 45 days left to expiration. We also like to trade options that are 1 to 2 strikes in the money. And this will ideally give us an option with a delta of around 60 cents. So in our example, we're going to take a look at buying the 38 put options, which are trading for $2.30 or $230 per contract, because you're looking at 100 shares per options contract. The 230, that is our maximum risk on this trade. Okay, that's a considerable savings when you compare it to having to use $6,000 to trade one futures oil contract. So we're going to make money on this position as the stock moves lower over the next 45 days. And our typical holding time on a long put is 3 to 15 days. So this allows us to get in and out pretty quickly before the time decay kicks in too badly on the options that we're trading. Let's take a look at an XLE call credit spread. Right, so this is a vertical spread for a bearish position on XLE. We're going to stick with that March monthly option. Okay, that has 45 days left to expiration. We're going to sell the 42-44 call credit spread to open this trade. So this has us selling the 42 call to open and buying the 44 call to open at the same time. So we are able to place this trade for 62 cents or $62 per spread. Now this $62 that we're collecting to place this trade is the most that we can make on the position. And this trade is using $138 of capital per spread, which is the most that we can lose on this trade. But the beauty of using a credit spread is we get 5 ways of making money on this trade. Okay, we can make money on this trade from XLE moving up, moving down, or moving sideways, as long as this price stays below $42 a share. We also make money from the time decay adding up and also from volatility decreasing. Okay, so this trade is a lot more forgiving when you compare it to buying a long call or put option or buying an oil futures contract, because we have multiple ways of making money. Our risk is fully defined. Okay, it's a great feature of a spread right there, because we can't lose more than $138 per spread. And that's calculated by taking the $2 difference between the strike and subtracting the 62 cents that we collected to put the trade on. So let's wrap this up. It might be kind of confusing, but as you can see, XLE, USO, both provide an inexpensive way to get exposure to the energy sector. Okay? These are really good alternatives to trading crude oil futures, which is a lot more aggressive and requires a lot more capital. We personally love to use simple option strategies on these markets, and they still give us a nice return potential while doing so with much more forgiving type of trades. As active traders, we like to use many different markets to get the diversification that's necessary to make money long term in many market conditions. So add XLE, USO to your watch list to take advantage of the volatile moves that take place on a regular basis in the energy sector. If you haven't checked it out yet, we've got a free video course, options crash course, that you should take a look at if you want to learn more about options. And if any part of this video was confusing to you, take a look at that video. It should help you out. Any questions, comments, drop them below. Talk to you soon.